Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. I am very grateful today to have a very special guest from Société Générale and obviously our very own Greg. Very pleased. Both are head of rates at their prospective firms, and I'm looking forward, with the Fed coming out this week to an exciting and informative conversation. So with that, Greg, maybe it's appropriate I hand it over to you.
Great. Thank you, Michael. It's always a pleasure to be here to do these with you. Subadra, thank you so much for joining. We've had a ton of wonderful guests, and we're thrilled to have you here. So we generally like to dive right into it. Obviously, it's a big meeting and maybe not such a big meeting given the advertising of taper, but love to get your thoughts, generically about, the statement, the notion of taper, what it could look like, and then in particular, maybe some thoughts on Powell's presser.
Thank you, Greg, and thank you, Michael, for the introduction. I think it's going to be a very interesting meeting. Taper is pretty much a foregone conclusion at this point. It's going to start in my expectations that they'll start tapering in mid-November and end tapering by the middle of next year. They're going to pretty much follow what they outlined in the September FOMC meeting minutes, where the pace is going to be around 15 billion per month. 10 billion in treasuries and 5 billion in mortgages. So I think that's pretty much baked into the cake, if you will. As far as the FOMC statement is concerned, we're looking at how they characterize developments in both inflation as well as on the employment front. They are going to declare that substantial further progress has been made on inflation, which we already know, but what they're going to do is change the statement to reflect that substantial further progress has been made both on inflation as well as employment. I'll also be looking to see how they characterize inflation. Thus far in the statement, they've said that inflation is largely transitory. I think that they probably stick to that language, but it'll be very interesting to see how they change, that particular sentence on inflation. And lastly, the presser is going to be very, very interesting, and the focus, ironically, might be more on the inflation aspects and market pricing of rate hikes than anything on the taper, because the taper is pretty much going to be on autopilot till the middle of next year. So it'll be interesting to see if Fed Chair Powell walks back the market pricing, if you will, on rate hikes, because a lot is already priced in. And it'll also be interesting to see how he kind of separates, the tapering, the criteria for tapering from the criteria for rate hikes, which he's done in the past. But now, recently, he's been acknowledging that, tapering that inflation could be a lot more, sort of on a more persistent. So it'll be interesting to see what the criteria are for them to raise rates versus tapering.
Yeah, no, that sounds perfect. I mean, certainly, the inflation dynamic has come front and center here. I think Powell, the Fed, clearly struggling with both those dynamics right now. So we'll stay on that topic, if you will, on the topic of inflation. What do you think about these numbers? I mean, last week, Friday, obviously the PCE core running at 3.6 year over year. We had the ECI came out. So obviously now wages, clearly a concern as well. Broadly speaking, what's your view on inflation now and heading into 2022?
I think the fact of the matter is it's really hard to know exactly how the inflation dynamics are going to play out. I'm broadly speaking sympathetic to the view that inflation is transient, because some of the longer term secular trends in inflation, whether it be the efficiencies with technology, whether it be the globalization and the demographic effects, should eventually bring inflation down. But the question is one of timing. Over the next year, we could there's a good chance that we could see inflation remaining persistent. And that's really going to change the Fed's reaction function, if you will. Things like supply chain disruptions, things like the labor shortages leading to higher wages could persist very well into the end of next year or beyond. You're also seeing in the recent CPI data that things like owner's equivalent rent are starting to continue to pressure rents higher. So inflation in general, some of these sort of sticky components could keep inflation higher well into next year. So for me, the real concerns are not just supply chain disruptions, but the more persistent sources of inflation, like owner's equivalent rent, medical care costs, as well as wages.
Interesting. It is interesting. Owner's equivalent rent, if you go back to the Fed minutes, they specifically mention that in terms of watching that very closely. So I definitely agree. We all see what's going on in the housing market here, which is front and center, which sort of brings me to the question and the notion of, we have this employment number on Friday. I think Powell himself, some of the Fed members think the employment market is actually still quite loose here. We have 4.5 million jobs still that were yet to recover through the pandemic. I think some Fed members, including myself, and I'm not a Fed member, but my thought is this market actually looks fairly tight by certain metrics. How do you think that plays out? We see the market pricing. Obviously, we see what's going on globally. Yields, these moves are unprecedented, what we've seen in a short period of time. How do you see the Fed balancing that out, assuming Powell is the chairman into 2022, the mandate, the inflation side versus the employment side versus how the market's actually pricing right now?
That's a very good question, because on the one side, we've seen a meaningful improvement on the employment front. We're going to get another print on Friday for the numbers for October, and what I should say for so what I'm really looking for is what's happening on the wage front, because we've seen a meaningful rise in the pace of job creation, but it's still somewhat lackluster. Really, where the concern for me is on the wage side. We've seen that the labor market shortages are still quite significant. You're seeing, if you look at the JOLTS job openings, you have close to 10 million jobs and only maybe 5 or 6 million unemployed. So we have to find a way to bridge that gap. And until that happens, I think low wage workers are going to see the wages start to rise. So I'm going to be looking more closely to the labor market shortages as well as the wage picture. Inflation, I think, is a very important concern. The question is one of whether it's persistent or transient, and that's where I think that you're starting to see a shift, not just in the US, but we saw the Bank of Canada, the ECB, and other central banks start to express concerns over the persistence of inflation over the next year. So there's sort of a global shift, if you will, from global central bank towards a much more hawkish central bank policy. So we'd be looking to see how the Fed sort of squares the circle on that. I mean, if you look at inflation expectations in Europe have increased quite dramatically. And the front end there is also sold off quite meaningfully. And if anything, inflation expectations in the US have been sort of playing catch up with global inflation expectations. So those are some of the dynamics that I think that the Fed and we'll be sort of trying to address in the upcoming meeting. And we'll be looking to see how that plays out on the policy front. For the most part, substantial further progress has been made, but I think there's still a lot more work that can be done on the employment front, especially when you look at metrics like participation. The participation rate is still very low. And it's not broad-based. So we'll have to be looking at those metrics before the Fed starts feeling comfortable that we've made substantial progress on employment, for them to feel comfortable to raise rates sometime next year.
Yeah, no, that makes perfect sense. Do you think the current market pricing, I mean, we've got, I think, over 50 basis points priced into 2022. I guess we can debate whether or not we think it's going to happen. Do you think that's appropriate at this point?
It's again, I would say the repricing has been really fast. The timing of the first rate hike has moved up quite significantly, and so has the pace of rate hikes for the next 2 years. But beyond that, the terminal Fed funds rate is still very low. You're looking at a terminal Fed funds rate between 1.5% and 2%, which is well below what the Fed expects the terminal Fed funds rate to be in its summary of economic projections. So the market is basically pricing in a sooner, faster pace of rate hikes, and that leading, if you will, to much lower growth over the upcoming years, and hence the lower terminal Fed funds rate.
Yeah,
so to me, Yeah, go ahead.
No, I'm sorry. Go ahead. Finish.
No, to me that feels like it's not necessarily how it's going to play out, because the curve is very flat, and I don't see the Fed allowing the curve to be flat or allowing for the cycle to be shorter than what the market what they would otherwise like.
Yeah, no, that's a great point. I mean, you've got this upward sloping and then flattening out curve. You look at that forward curve, even the 10-year, still very benign, a tightening cycle that really gives the Fed credit to try and pull back here a little bit, but over time, not tightening all that very much. So no, that's great. I appreciate all your points and your thoughts. I think they're all great and completely spot on. Mike, I'm going to turn it back to you if it's okay.
Subadra, thank you so much for taking the time and to give us some great insights on the way you are seeing things from your purview. It's always very helpful to us. I guess I'll end it with one question, and maybe both of you can take a crack at this. With all the concerns over inflation, would the Fed ever raise the funds rate while still buying assets? Is that an actual possibility?
I'm going to give you a short answer. I don't think so.
Okay, Greg?
I don't think so either. You know, the Fed has been pretty explicit, taper, then rate increases. I think what could potentially happen, I think we'll hear a little bit of this on Wednesday, that the tapering will be contingent upon economic conditions. So the Fed could speed things up, they could slow things down. And, you know, Powell himself has said, look, if we need to, and we need to speed things up, we can do that. So I don't think that would be an ideal scenario for risk assets, but I think their first course of action would be to try and get asset purchases down to zero very quickly, and then raise rates after that.
Certainly makes a lot of sense. I figure I'd ask the question. Subadra, you want to add something?
Yeah, no, to that point, I think that the underpriced risk in the market is a much faster pace of tapering. You know, Bullard's the only regional Fed president that's sort of pointed to the possibility of a faster end to taper. If inflation actually is a real concern, then the risk is that they might have to speed up their tapering, end their tapering by first quarter, and hike in June.
Perfect. Well, you know, we're running up against the clock here. First and foremost, Subadra, thank you for being so generous with your time. On behalf of AmeriVet, we are extremely grateful to your time this afternoon. And to my
Thank
partner,
you for having me.
of course, and please come back again. And to my partner, Greg, as always, you know how much I love doing this with you. It's always a great time. We've been doing it for a very long time now. If any of our clients have any questions or would like to speak to Greg, please reach out to your AmeriVet representative. As we always say here, please take care of your families and be safe. Thank you so much.